Good morning, everyone. Bonjour tout le monde. Welcome to the Bank of Canada and this morning's press conference about today's interest rate announcement and our monetary policy report. Avant que nous tournions aux vos questions, le gouverneur Macklem va prononcer une déclaration préliminaire, and after his opening remarks, Governor Macklem and Senior Deputy Governor Carolynrogers will be happy to take your questions until about 11:15 or so. Alors, Monsieur le Gouverneur, à vous la parole.
Thank you, Paul, and good morning. I'm very pleased to be here with Senior Deputy Governor Carolynrogers to discuss today's monetary policy report and our decision. Today, Governing Council held the policy interest rate at 2 3/4%. This decision reflects three main considerations. First, uncertainty about U.S. tariffs on Canada is still high. Discussions between Canada and the United States are ongoing, and U.S. policy remains unpredictable. Second, while U.S. tariffs are disrupting trade, so far Canada's economy is showing some resilience. And third, inflation is close to our 2% target, but we see evidence of underlying inflation pressures. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,75%. Cette décision reflète trois grandes considérations. Premièrement, l'incertitude au sujet des droits de douane imposés par les États-Unis au Canada est encore élevée. Les discussions entre les deux pays sont en cours et la politique commerciale américaine reste imprévisible. Deuxièmement, même si les droits de douane américains perturbent le commerce, l'économie canadienne montre une certaine résilience jusqu'à présent. Et troisièmement, l'inflation est près de notre cible de 2%, mais on voit des signes de pression inflationniste sous-jacente. Today's interest rate decision is accompanied by our July monetary policy report. And as in April, we decided not to present a conventional forecast for growth and inflation. U.S. tariffs are still too unpredictable to be able to provide a single forecast for the Canadian economy. So we present three scenarios. The first is what we're calling our current tariff scenario, and it represents a view of how growth and inflation would evolve if the trade arrangements currently in place or agreed were to remain. The two other scenarios examine how things could play out if tariffs escalate or if they de-escalate from where they are now. These three scenarios are designed to capture the uncertainty around U.S. trade policy. There's also uncertainty about how businesses and individuals in Canada and the United States will adapt to this new trade environment. The increases we've seen in U.S. effective tariff rates are less than what was threatened, but they are still outside post-war historical experience. So in addition to using scenarios to help guide monetary policy, we've stepped up our regional outreach to help understand the impacts of tariffs and uncertainty across the country. And we're adding questions to our surveys of Canadian households and businesses. I want to underline that the lack of a conventional forecast does not impede our ability to take monetary policy decisions. But the unusual degree of uncertainty does mean we have to put more weight on the risks. We're looking at over a shorter horizon than usual, and we are ready to respond to new information. So let me provide some details on what we've seen since June. Some tariff agreements have been negotiated between the United States and its trading partners, and that has reduced the risk of a severe and escalating global trade war. Unfortunately, the tariffs in those agreements also suggest the United States is not returning to open trade. So far, the global economic consequences of U.S. trade policy have been less severe than feared. U.S. tariffs have disrupted trade in major economies, and this is slowing global growth, but less than many anticipated. While growth in the U.S. economy looks to be moderating, the labor market has remained solid. And in China, lower exports to the United States have largely been replaced with stronger exports to other countries. In Canada, we had robust growth in the first quarter of 2025, mostly because firms were rushing to get ahead of tariffs. In the second quarter, the economy looks to have contracted as exports to the United States have fallen sharply, both as payback for the pull forward and because tariffs are dampening U.S. demand for our goods. Growth in spending by Canadian businesses and households is being restrained by uncertainty, and new U.S. tariffs are having profound impacts on directly affected sectors. A number of economic indicators suggest that excess supply in the economy has increased since January. Nevertheless, the Canadian economy is showing some resilience so far. A number of surveys suggest consumer and business sentiment is still low, but it has improved. And in the labor market, we're seeing job losses in the sectors that rely on U.S. trade, but employment has kept growing in other parts of the economy. The unemployment rate has moved up modestly to 6.9%. In our current tariff scenario, growth resumes following the second quarter contraction. GDP growth is about 1% in the second half of this year as exports stabilize and household spending increases gradually. The scenario then has growth picking up further in 2026 and reaching close to 2% in 2027, although the path for GDP is permanently lower owing to tariffs. Turning to inflation, CPI inflation has been pulled down by the elimination of the carbon tax and is just below 2%. However, a range of indicators suggest underlying inflation has increased from about 2% in the second half of last year to around 2.5% more recently. This largely reflects an increase in non-energy goods prices. Shelter cost inflation remains the biggest contributor to CPI inflation, but it continues to ease. Surveys indicate businesses' inflation expectations have fallen back after rising in the first quarter, but consumers' expectations have not come down. In the current tariff scenario, there are a number of offsetting upward and downward forces at play, which we outline in detail in the monetary policy report. If I try to boil it all down for you, there are reasons to think that the recent increase in underlying inflation will gradually unwind. The Canadian dollar has appreciated, and that reduces import costs. Growth in unit labor costs have moderated, and the economy is in excess supply. But at the same time, tariffs are imposing new costs, which will be gradually passed through to consumers. In the current tariff scenario, the upside and downside pressures roughly balance out, so inflation remains close to 2%. The picture is somewhat different when we look at the alternative scenarios. In the de-escalation scenario, lower tariffs improve the growth outlook and reduce the direct cost pressures on inflation. In the escalation scenario, higher tariffs weaken the economy and increase direct cost pressure. There's also uncertainty about the impact of tariffs. Many businesses report they are facing costs related to finding new suppliers and developing new markets. These costs are difficult to evaluate, and they could add upward pressure to consumer prices. We will be following tariff developments closely and assessing indicators of underlying inflation. Lors de cette décision, le consensus était clair: laisser le taux directeur inchangé. Le Conseil a aussi convenu qu'il faut procéder avec prudence, en portant une attention particulière aux risques et aux incertitudes qui touchent l'économie canadienne. On va continuer d'analyser l'évolution et la force des pressions sur l'inflation, celle à la baisse due à l'affaiblissement de l'économie et celle à la hausse découlant de la montée des coûts en raison des droits de douane et de réorganisation du commerce. Si l'affaiblissement de l'économie fait peser des pressions à la baisse supplémentaires sur l'inflation et que les pressions à la hausse sur les prix dus aux perturbations commerciales sont contenues, on pourrait devoir baisser le taux directeur. At this rate decision, there was a clear consensus to hold our policy rate unchanged. We also agreed that we need to proceed carefully with particular attention to the risks and uncertainties facing the Canadian economy. These include the extent to which higher U.S. tariffs reduce the demand for Canadian exports, how much this spills over into business investment, employment, and household spending, how much and how quickly increases from tariffs and trade disruption are passed on to consumer prices, and how inflation expectations evolve. We will continue to assess the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure on inflation from higher costs related to tariffs and the reconfiguration of trade. If a weakening economy puts further downward pressure on inflation and the upward price pressures from trade disruption are contained, there may be a need for a reduction in the policy interest rate. We are focused on ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. We will continue to support economic growth while ensuring inflation remains well controlled. And with that, the Senior Deputy Governor and I would be very pleased to take your questions.
Thank you, Governor. We will go to questions now, and we'll start with those reporters who are here in Ottawa at the bank, after which we'll go to those who have joined us remotely. As usual, I'm going to ask you to please limit yourself to one question so that every media outlet has the chance to participate. If I forget to do so, please state your name and affiliation. For those in the room, please press the button on the microphone in front of you to activate it so that everyone can hear your question, and then press it again to turn it off once you are done asking. Avant de poser votre question, veuillez-vous identifier si je ne l'ai pas fait, et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's get started first with Paul Vieira from the Wall Street Journal, please.
Good morning. Even if there's some sort of agreement reached between Washington and Ottawa by the August 1st deadline on the current tariff row, won't the pending review of the U.S.-Mexico-Canada trade treaty keep uncertainty elevated in Canada and thereby thwarting business investment and slowing household consumption for the foreseeable future?
Paul, I would agree that, let's hope there's an agreement between Canada and the United States. Let's hope it's a good agreement. But yes, there is a sense that U.S. policy may well remain unpredictable. There is a sense that trust is not, it's going to be hard to restore trust. So yes, I think some level of uncertainty will continue. And in the scenarios, particularly the current tariff scenario and the escalation scenario, we do have a fair amount of uncertainty through much of the projection. It does diminish over time, but it's not falling off quickly in that current tariff scenario. In the de-escalation scenario, there is some reduction of uncertainty, but we don't eliminate it. There is still an uncertainty effect.
Okay, next we'll go to Greg Quinn from Market News. Go ahead, Greg.
Hello. I mean, even though there's some mention of a possibility of a need to cut rates if trade gets worse, the central projection has core inflation above 3% on a quarterly basis through the rest of this year. I mean, how significant a barrier is that kind of sticky trend inflation to providing relief to Canadians?
Well, I mean, just coming to the decision we just took, one of the reasons why we held the policy rate unchanged is because, yes, we have seen some additional pressures in underlying inflation. Core measures, the trim mean, trim median have been running around 3. If you look at a broader range of core measures, they're closer to, they've all moved up. They tend to be a bit lower than trim and median, our preferred measures. So yes, that has got our attention. And going forward, we are going to be watching closely what happens with those pressures on underlying inflation. As I mentioned, some of the factors that may be causing that increase should unwind. The Canadian dollar is appreciated after depreciating. That should pull import costs down. unit labor costs, wage growth has decelerated, and the economy is in excess supply. We think the economy contracted in the second quarter. So those things are all going to put downward pressure. Now, tariffs, we're just starting to see the effects of the tariffs and the countermeasures in CPI inflation. You can see it a little bit in food. There's probably some more to come there. So that's going to put some upward pressure. So we're going to be gauging closely those upward and downward pressures. I think the message overall, Greg, is monetary policy is going to continue to support the economy while ensuring that inflation remains well controlled. That's what's on our mind. That's what will guide our decisions.
Next, I'll call on Kevin Carmichael from The Logic, please.
Good morning. My question is, I think, would be a follow-up to Greg's. Can the bank live with an inflation rate of around 2.5%, or is that still uncomfortably high?
Well, the way I would put it is when we're taking our monetary policy decisions, we're really thinking about where inflation is going to go. So if inflation's currently 2.5%, but we think the evidence is suggesting that inflation pressures will unwind and we're heading back to 2%, yes, we're comfortable. If we think inflation pressures are building further and we're moving further away from the target, we're uncomfortable. One of the messages today is, it's hard to be as forward-looking as usual when you've got an unusual amount of uncertainty. And that's why we presented three scenarios. And you can see that the inflation outturn is different in those different scenarios. And the reason we presented three scenarios is, against a background of unusual uncertainty, we need to be thinking more about the risks. So as we're thinking about policy, we're not thinking about a single forecast. We're thinking of a range of scenarios. We've had to shorten our horizon. Hopefully, things will get clearer. We can revert back more to normal. But we'll see exactly when that happens.
Next, I've got Mark Rendell from the Globe and Mail, please.
Hi, Governor and Senior Deputy Governor. Thanks for the question. So in the NPR, you talk about the effective tariff rate on Canadian goods increasing by 5 percentage points, but you don't state what the baseline was for that. So I'm wondering, first of all, what is the bank's estimate of the current effective tariff rate on Canadian goods entering the U.S.? And secondly, how did you come up with the estimate that 95% of Canadian goods can become USMCA compliant?
Sure, I'll tackle that one, Mark. So there we go. So to your first question, really, the short answer to the effective tariff rate of 5%. Where was the baseline? It was close to zero, it's just barely above zero. How we get there, we look at the U.S. Census Bureau data, and then you look at the sort of composition of the goods coming into Canada, or coming into the U.S. from Canada, and you get to an effective tariff rate.
And that's about 5%.
Yeah. The 95% compliant, again, you have to look at the composition, and it's also a forecast. So there are exporters to the U.S. that qualify to be CUSMA compliant, but maybe haven't completed the paperwork. They're more motivated to do that now, so we expect more and more goods to become compliant with CUSMA. And again, you have to look at the composition. So, and the composition not just of the firms that are exporting and whether they're compliant, but the total of goods that are going into the U.S. market.
Yeah, I just underline, Mark, these are scenarios. They're based on a lot of assumptions. The situation is fluid. Canada and the United States are, those discussions are ongoing. We'll see where they land. The reason to put out scenarios is really to reflect the fact that there is more than one outcome here.
Okay, next let's go to Promit Mukherjee from Thomson Reuters.
Thanks, Paul. Good morning, Governor and Deputy Governor. problem. Yeah. Sorry. What I wanted to ask is, in your current tariff scenario, do you think that if inflation and the GDP evolves the way you have projected, will there still be a need for a rate cut this year?
So you want to know where rates are going, basically. Okay, look, let me say three things. I mean, the first obvious thing to say is, I mean, we're going to take our decisions one decision at a time, and our future decisions are going to depend what happens in the future. But look, I can say three things. I think the first message is situation hasn't changed that much since our last decision. We continue to proceed carefully. Given the unusual amount of uncertainty, we're continuing to put more weight on the risks, and we're ready to respond to new information. The second thing I would say is we have been very clear about what we're watching most closely, what we're particularly focused on. And those are the four things I outlined. We're looking, how much are U.S. tariffs impacting our exports? How much is the weakness in exports spilling over into business investment, into employment, and into household spending? How quickly, how big are those direct costs? How quickly are those getting passed through to consumer prices, and what's happening with inflation expectations? And then the other thing we've said is that, looking ahead, if the weakness in the economy creates further downward pressure on inflation, and those upward pressures from tariffs and trade disruption are contained, there could be a need for a further cut in our interest rate. So I think that gives you, a sense of how we're assessing the situation. What are we going to be doing? Like everybody else, we're going to be following the developments in terms of the Canada-U.S. trade relationship very closely. We're going to be looking at those upward and downward pressures. We've given quite a bit of detail about the various indicators of underlying inflation that we're looking at. And, as I said previously, I think what you can count on us for is we will continue to support the economy while ensuring inflation remains well controlled.
Okay, let's come over to this side of the room now. I'm going to call on Jordan Gowling from the Financial Post next.
Morning. You are not expecting a recession this year under the current tariff scenario, with a contraction in second quarter, but positive growth starting in the third quarter. What are the factors you are considering when we're talking about that bounce back starting in the third quarter?
Yeah. So the first thing to stress is that the quarterly profile of GDP is being very affected by these big swings in exports related to the tariffs. So first quarter GDP in Canada is boosted quite a bit because exporters were trying to get ahead of the tariffs, and U.S. importers were also trying to get goods from Canada ahead of the tariffs. So you saw GDP growth in the first quarter was boosted by a surge in exports, 2.2% growth the first quarter. In the second quarter, you're getting the payback from that. You've pulled all the exports forward. There's very little exports in the second quarter, so you're going to see a very sharp decline in exports in the second quarter. Interestingly, U.S. GDP came out this morning for the second quarter, and you saw a huge drop in U.S. imports that boosted U.S. GDP. Well, that big drop in their imports, that's a big drop in our exports to the United States. That's the flip side of it. So there is a very sharp deceleration in exports in the second quarter. That pulls growth negative, so you get a contraction in the second quarter. When you get to the third quarter, we're not expecting a big bounce back in exports, but having declined sharply, they shouldn't be again subtracting as much. So, and when you set exports aside, what you're seeing on the consumption side is you're seeing consumption is still growing. It's growing modestly. It's certainly being restrained by the uncertainty caused by tariffs, but it is growing, and we expect that to continue through the third and fourth quarters. So you get the third and fourth quarters, you get modest growth, I think is the message. You get a contraction in the second quarter, you get modest growth through the rest of the year. I mean, the second quarter's happened; it's over. You get modest growth through the rest of the year, and in that current tariff scenario, growth picks up further through 2026 and 2027.
Okay, let's go to Mackenzie Gray from Global, please.
Hi there. Back in early May, Governor, you said that you could expect, or you expect that there'll be some permanent scarring in the Canadian economy due to the tariffs. We're a couple months on now. There's been a lot of data. Things have evolved. What's your analysis on that situation? Do you think there are substantial impacts that have already been felt that won't be going away in the future?
Well, if you look at if you look at the monetary policy report, actually, there's a picture. You know, one of these things where a picture says 1,000 words. If you look at chart 27 and panels A and B, so it's on page, if you have a hard copy, page 48, 49. So what you see is, so in the current scenario, and even in the escalation and de-escalation scenarios, growth goes down with the impact of the tariffs. Growth eventually gets back to around 2%, but growth goes down, it gets back to 2, it doesn't go above 2. So what that means is that the economy is on a permanently lower path. So yes, I mean, look, unfortunately, the sad reality is that tariffs mean the economy is going to work less efficiently. It means, you know, there's going to be less income. So there's going to be less consumption. So yes, the economy will resume growing, but it'll be on a permanently lower path. And in that sense, yes, the tariffs have a permanent effect on the economy unless they're removed.
Right, let's go to Rachel Ayo from CTV next, please.
Hi, thank you. So Ontario Premier Doug Ford has just come out and said that he is shocked by this decision and he is calling on the bank to cut interest rates now. How would you respond to that?
Well, I haven't seen his comments, but look, we take our decisions independently of the political process. We take them based on our best judgment as to the interest rate setting that will fulfill our mandate. And I think I would underline that the experience of the last few years has really highlighted just how much Canadians don't like inflation. We will support the economy through this period of upheaval, but at the same time, we are going to make sure that an inflation problem, a tariff problem, does not become an inflation problem.
Let's go to Randy Thantong Knight from Bloomberg, please.
Does the bank see settlement balances currently headed to a level that would require you to bring forward purchases of treasury bills? Is that something you're considering?
Sorry, can you repeat the first part of the question?
Does the bank see settlement balances currently headed to a level that would require you to bring forward planned purchases of treasury bills?
I'm assuming you're talking about our settlement balances, and yeah. I mean, our plan that we've shared in previous press conferences on settlement balances hasn't changed. We're on a continued trajectory down. We still think we'll settle somewhere between $50 and $70 billion at the end of the day. We're getting closer to that number, Randy, but we've got a ways to go yet. So there's no change. The bottom line is that we don't have any change to our plans right now.
Okay, and I'm just going to check at the back. Craig, did you? Yep. Okay, Craig Lord from Canadian Press, please.
Hi, governors. You've talked about the economy showing some resilience. We are seeing some industries, steel producers, taking a heavy hit from these tariffs, though. How does the Bank of Canada make sure that sectoral weakness in the economy doesn't spread to become broader and spread to other industries?
So yes, just to elaborate on the first part, U.S. tariffs are having a profound impact on the sectors they've been directly applied on. So, steel and aluminum, 50% tariff, having a very direct, severe effect. When we say the economy is showing some resilience overall, what we're saying is that when you look beyond the directly affected trade sensitive sectors and you look at the rest of the economy, it is continuing to grow. If you look at employment outside of sectors heavily dependent on U.S. Employment in the rest of the economy has continued to expand. As I mentioned in a previous question, consumption growth is modest, but it is continuing to grow. So, look, the economy is weaker, but it's not sharply weaker. It is showing some resilience so far. And that really gets to the second part of your question. We will be watching closely what happens. Part of that is going to depend what happens with tariffs themselves, and that's why we produced these three scenarios. Hopefully we move more towards a de-escalation scenario, and we get a stronger bounce back in growth than we have than is in the current tariff scenario. But we've got to be alive to the possibility that, that's not the only possible outcome. Clearly monetary policy is not a tool that you can use to target specific sectors. That is something really that's more in the hands of fiscal policy. The government has introduced some policies to address the stress in particular sectors. We need to look at the economy overall, and yes, we're looking at exactly that. How much spillover are we getting from the most effective sectors into the rest of the economy? So that is something that will be very much a part of what we're looking at, and really to getting to that forward-looking statement. If those spillovers are bigger and there's more downward pressure on inflation and the upward pressure from tariffs and trade disruption are contained, there may be a need to cut interest rates further.
Okay, that's it for the folks in the room. We're going to go to reporters who have joined us remotely now. I'll just remind you folks on the line, come off mute only to ask your question, please, and then go back on mute as soon as you've finished. That way everybody can hear the response. I've got Max Sato, John McFarlane, and Rob McClister on my list. So let's go there in order. Max Sato from Mace News, please.
Morning, Paul. Thanks, Governor. I was going to ask you a simpler question about what you told us last month, which is the only forward-looking per se you have is proceeding carefully, and also you said being less forward-looking than usual. But I'd like to ask you a longer question with the context of recent shift in voter sentiment around the world. As we can see, voters have turned more right-wing in many economies, and that's reversing earlier moves toward more open global trade and immigration. We've seen that south of the border, and more in the most recent case in Japan, LDP and Komeito coalition lost majority in upper house after their loss in lower house. It's a smaller party, fringe party, yet, but it's obviously people are choosing kind of a right-wing party saying Japanese first. And I'm just wondering if any uncertainty over trade wars is clearing up, and you could see this forward-looking. And but compared to the U.S., you don't have a prime minister tapping you on the shoulder, say, "Hey, I want you to just cut interest rates." Does that make your life and your job and your colleagues' job easier than your counterpart at the Federal Reserve?
Okay, there was a lot in there. The answer is really I think I need a speech to answer the question. But look, starting first on the trade part, look, there's no question the new U.S. administration, President Trump, has dramatically increased U.S. protectionism. The effective U.S. tariff rate with the agreements that have been reached has increased significantly, and that is going to have an impact on the world economy. But even before President Trump was elected, trade has been shifting. Previous administration the first Trump administration, the Biden administration, there were more restrictions on trade. And around the world, trade needs to factor in national security in a way that it hasn't as much in the past. In the past, you could really optimize purely for efficiency. Now you have to think about national security. The world is fragmenting, and that is going to have an impact. And yes, obviously we don't weigh in on politics, but yes, some segments of society feel like they've lost out. That is having political consequences. So yes, the trade environment has been shifting, and Canada needs to think about its place in the global trading economy. We are very concentrated in our trade with the United States. We've been that way for a long time. I think there are opportunities to diversify our trade, and I won't get into the government's plans, but clearly they are articulating plans to try to reduce interprovincial barriers. That should help grow our internal market, help get goods to Tidewater so we can get them to other countries. These are the kinds of things we need to be thinking about. The message is the world is changing.
All right, next I've got John McFarland from Yahoo Finance Canada. Go ahead, John.
Hi, thanks for taking my question. This question is in the context of longstanding concerns about productivity. I'm wondering about the bank's thoughts around the plans for massive increases in defense investment, which are coming sooner than later. Does the bank expect them to help or hurt productivity, or do they see them as benign?
It probably depends how they play out. I think in the long run, they probably will help productivity. I mean, ideally, what we want to see is those investments in our own economy, so that they build our own capacity. They generate some economic activity within Canada. So that effect won't be immediate. Those things take a long time to play through the economy. But yeah, there is we can be optimistic that that'll be net positive to productivity.
Okay, and finally, I've got Rob McClister from Mortgage Logic News. Rob.
Good morning. With markets pricing in roughly 4 Fed cuts in the next 12 months, I'm wondering if you could help lay people understand how the bank factors in Fed cuts in general. So in other words, assuming the effective tariff rate persists at around 5% or so, and other things equal, how much could Fed cuts indirectly stimulate inflation in Canada, making easing potentially less necessary here?
Well, my short answer to that is we have a flexible exchange rate, so that we can gear monetary policy to the needs of the Canadian economy, and I'm confident the Federal Reserve will gear monetary policy to the needs of the U.S. economy. We've obviously reduced interest rates quite a bit more than the Fed. Our economy was weaker through last year. As we reduced rates, we were seeing actually economic activity pick up with inflation around 2%. Of course, the situation has changed with new U.S. tariffs. But yes, we'll watch closely what the Fed does, and that's something that we will take into account in terms of our own monetary policy. But I mean, I think the best thing the Fed can do for us is to do a good job managing monetary policy in the United States.
And with that will wrap up today's press conference. So thank you, Governor Macklem, Senior Deputy Governor Rogers, and thanks to all of you out there for spending time with us today. See you in September.
Have a good summer.
Thanks very much.